equation, for the financial performance, the same principle applies for basically where we look at the accounting equation. It's the same thing. Assets must be equals to equity and liabilities. And with the financial performance, we actually look at the financial results of the entity, where normally for the main measure to determine how a company did well is based on the profit or the loss it made over a specific period. Most companies, it depends on companies, but mostly as a minimum within 1 year, there must be some kind of, that's where they actually prepare financial statements. So they can actually prepare over a 6 months period, or even some, they say they do the financial statements over quarterly. But what happens is most companies on quarterly basis, they just do a snapshot to say, for example, we'll only do the financial position and elements of the financial performance for quarterly basis. As you know that the full set of financial statements, that's where we refer to statement of financial position, statement of financial performance, the cash flows, the notes to the financial position and financial performance, the cash flow statements, and as well as the statement of changes in equity. So when we say, okay, the company has prepared those, that information is actually required over a period of 1 year. But what they can do is to say every 3 months to say, we actually focus more on the statement of financial position, which is the balance sheet, and the income statement, which is statement of profit and loss and other comprehensive income. But those two, we can actually do it, for example, on 3 months basis or on 6 months basis. So when a company actually generates more income than it actually all the expenses which it has incurred in making that business, that's when it says the company has actually made a profit. But if you find your expenses are actually higher than what income you're actually getting. So for example, if you say, for example, your nature of the business is actually to rent buildings, and you say, okay, I get 5,000 rental from renting these businesses. But when I calculate the levy I need to pay, when I calculate the water and electricity, when I calculate the rates, when I calculate the security, I'm actually spending 6,000. In that case, you're actually sort of making a loss because your expenses is actually higher than the income of the 5,000 you're getting. So the profit or loss for the year, actually you determine on which one is higher. You take all your income and then you minus the expenses. That's where you actually get profit or loss for the year. So for an entity to continue as a going concern, as time goes on, you'll see you actually need to, you can make losses for a year or two, but take into account that losses are actually depleting the capital which the owners have put into the business. So if each and every year you actually keep on making losses, it means that capital will end up being depleted. And in that case, it means the owner will maybe need to say, for the business to survive, the owner will need to put in more money. But it means the owner is not getting any reward because they keep on putting money, but they're actually not getting anything from the business. So the entity, the main aim with a new business, you expect it to make loss, and then until it breaks even, then it starts making profit, where they will be able to sustain itself and also be able to generate some income for the owners. So when this income is actually generated by the business, at the end of the year, that's where we actually credit it to equity. And this equity, remember equity we said is the money which actually belongs to the owners. So the company will make a profit, say for example, of 500, and either with that 500, mostly it will say is maybe taking 100 and paying as dividends, which is actually pays to the owners, and maybe take 400 is actually retaining it as equity. So if it actually retains it as equity, is actually effectively belongs to the owners of the business. It's just that they still have that element to say, this one we can still use it if we want within the business without asking the owners to put in some money into the business. So this is the accounting. This is how the T balance, based on the accounting equation, looks for the financial performance side. So from the these are the accounts which actually increase, like on the credit side. So we've got your income, or like your capital. So it actually increases on the credit side and decreases on the debit side. Same as when you've got a profit. So profit will increase on the credit side and decrease on the debit side. So these are the rules which, like, you must know to say if you are dealing with an income item. When you come to say this is the profit, say for example, you say services rendered account, you'll know that, okay, this is an income as a business I received. So for me, you need to know where do you actually credit it, where do you actually debit it, but you actually need to know, is it an increase or is it a decrease? So you actually need to know these rules to say, as an income, it increases on the credit side, or if you'll say, for example, you want to do a reversal on one of the items, you say, okay, now I'm decreasing it, I need to put it on the debit side. So this is just to look at the income section. Then we'll also just have a look at the expense side, just to see which items mostly you come across. So when we refer to profit or income, it's actually the one where you'll say economic benefits of an entity are going to increase, which effectively increases your equity. So they can also be as a result to say when your assets increase, or for example, you say your liabilities decrease. But some of the revenue can also be earned like normal business activities. Say if the company says it's business, maybe you're dealing with ShopRite, for example, it says it's selling goods, so there will be sales. If there's a company which says it generates most of the income from the fees earned, or rental income, interest income or rental income, and also like maybe you'll say mostly it's getting commission. So you might find that the nature of the business, some companies, they may be act as a middle person to say, we'll maybe buy this on behalf of someone, then that other companies just pays as commission. That's maybe their source of revenue which they actually put in, and then that's also an income. And you also have gains, maybe, which in a company we call it gains because it's not normally, say for example, ShopRite is not in the normal activities for that company, but ShopRite can, for example, say, okay, we've got 5 trucks, but actually now we need 4. So we can actually sell one of the trucks, because ShopRite's business is not to sell cars. That actually comes in again. But it's actually different when you say you're dealing with VW, because their main aim is to sell vehicles. That for them, it won't be gain, it will be revenue. So what can be gain in another company, it can be normal business activities for the other company. So looking at the expenses, it relates to an outflow of economic benefits. So this is actually where you'll say your equity actually decreases. So expenses are normally incurred in the normal course of business, and they need to be for the purpose, must be for the generation of income. So before you actually put expenses into the business, they need to be incurred for the purpose of generating the income. So some of them can be direct, like your cost of sales, where shop prices, I'm actually, I need to sell, say for example, bread. Then they say, Albany, give me 5 loaves of bread, then I'll sell it. That's your cost of sales. Then they pay 5 rand, then they sell it to you for 7 rand, for example. So that 5 rand they're paying is the cost of sales. That's 7 rand they're getting is their revenue. That's actually a direct one. But there's also indirect expenses where they say, we need to lease in a complex, we need to pay rent. So they also need to take that into account. Maybe, for example, they say we have 5 employees, we need to pay them. We need to advertise so that people know about our business, people know about our specials. They need to pay for those expenses, water and electricity, and any other admin expenses. So all those expenses, as long as it's for the main aim, is for them to say, if we actually do not pay rates and taxes won't be able to operate. So it's actually they need those expenses for them to generate that sales. So they put it into the business. So the same applies to say there's losses where you say it doesn't arise from the sale normal activities. Say, for example, they can have a same example of a truck where they say, okay, we're selling one truck, but in our books, we think our truck is actually worth 100,000. But they try to sell that truck for 100 or 110, but they could only get one person says, I'm willing to give it to you for 80,000. And they think it's better than nothing. So let's at least get this 80,000. But remember, they had this asset for 100,000 in their books. So that 20,000, and for your accounting equation to balance, if they come and say, we are selling an asset for, our asset is going to decrease by 100,000 to actually cancel it off our books, but we're only getting 80,000. There's a 20,000 which is actually remaining. So they actually need to say that 20,000 is a loss, and then they also need to record it on their books. So the T balance for expenses. So as mentioned, expenses are incurred to earn the income. So this is where it's actually opposite to what your income is. So your income increases on the credit side and decreases on the debit side. But with expenses or any losses you incur, so they increase on the debit side, and then they decrease on the credit side. So, and this is actually the same principle where you actually have a look at it when you're doing your trial balance. So for an item of an expense, you'll see it on the debit side. For an item of income, you'll actually see it on the credit side when you look at the trial balance. So we'll just go through a trial balance for some of the expenses so that you will see actually to say this is the same rule which we actually following, and taking into account that your expenses effectively decreases your equity. But what we're aiming for is we'll say, okay, these are all our expenses, these are all our income. We come with one line item, which is your profit or loss. And when it comes to your equity, we only just take that one account there. But effectively, all of these, they're actually going to your equity account. So I think there's just some examples. So we'll just go through this and just to see how it's debited and credited. And then we'll just go to Excel, and then where we actually do the actual general ledger to see how the actual picture will look like. So for this transaction, say for example, transaction 1 will say company A, they render the service on the 15th of Jan for cash for the amount of 60,000. So what actually the first step you need to say is which two accounts are involved in here. First thing first is you say, okay, it's for cash, so your bank account is involved. And as already you have an amount, so it's 60,000. So when you come to say your bank, to say what happens to your bank account, I say because currently, remember, we're dealing with company A, it actually rendered the service. What's happening to your bank account? Did we get money or are we paying money? So we rendered the service, so it means we are getting the money. So, and with that case to say, okay, we need to increase our bank account. So you need to say, okay, bank, is it an asset? Is it an equity or a liability? So must remember that bank is an asset, and which side does an asset increase and which side does an asset decrease? So assets increase on the debit side. So we need to come to say, okay, we received money for this account. So we'll go to Excel and then we'll see how we record it. But I just wanted us to go through the theory part, and then we'll just go through the examples to see how it's actually done. So we'll say, okay, this we received money, so our bank account actually increases. So we're actually debiting our bank account. Remember what you do on the left, you must also do on the right. So if we actually debited the bank account, so I think with accounting is if there's one account you actually show off the direction it's supposed to go, it means the other one, it needs to be the opposite. You can't come and credit two items, basically. what you debit, you need to debit something and credit something. So in this case, we say, okay, we debited the bank account. We need to find out which account are we crediting. So in this case, we said it's for services rendered. So services rendered is like an income where we'll say where does an income actually increase? Actually increases on the credit side. But if you are sure of the bank account to say, I know my bank account is going to be on the debit side, what's actually left for you is actually to say, on the credit side, what do I put in? Already you know that you need to go to the credit side because you need to make sure that what you do on the left, you also do on the right. So what you debit, so the total for your debit side must always be equal to your credit side. So each and every transaction, you must make sure that you actually balance your accounting equation. So with bank account, we say bank account is an asset. So it actually increased, we received the money, and so actually debiting it. And with income, we'll say, okay, income is actually services rendered is an income, and income actually say it actually increases on the credit side, and so must actually credit it. So we'll just quickly just go to Excel, but let's just go through all the examples and then we'll just do all of them together. So transaction 2, we are saying this company rendered the service, same thing, but on credit this time instead for cash for the amount of 20,000. So if it actually, the service rendered part will actually be the same, where we actually saying it actually rendered the service, it's an income, and then which is equity, and then we increase it on the credit side. So we must actually credit our service rendered account. So now is the, if we know that we actually crediting our services rendered, what account must we actually debit? So in this case, because this was on credit, we must actually say this person is actually owing us. So a person who owes us is called a debtor. So we have a debtors account. So in that debtors account, we need to say, okay, we need to debit our debtors account, where normally we'll just say, with debtors account, what we do, we separate a debtors book, basically what's called the debtors book, but it all goes to the debtors account. So you can say debtors account or debtor, and then you put in bracket for, you create the debtors account where you see each and every person, how much a person owes. But in total, you also have somewhere where you also see to say, in total, I am owed 5,000. But MGT actually, for example, owes me 200 or that kind of a thing. So a debtor is actually an asset as it meets the definition. So this is the definition of an asset, to say it's the resource controlled by an entity as a result of past event from which future economic benefits are expected to be received. So if it meets that definition, it's an asset, then we record it as an asset. And remember, assets increases on the debit side, so we need to debit it. So with transaction number 3, so here we just gonna say, okay, now we have an expense item. We'll say on the 28th, the business actually had the telephone account for January, which was actually paid by check for 1.2. So in this case, the moment you say paid by check, you know it's actually your bank is involved. So with this thing, it's like now we're saying you paid by check, you actually, your bank account is involved, but what happened to your bank account? Did your bank account increase or decrease? So in this case, your bank account decreases because you took money and paid for your telephone account. So as an asset, which side does the bank account decrease? It actually decreases on the credit side. So you actually need to credit your bank account. And expense, telephone expense, this one is a telephone account, which is an expense. You'll say which account is actually affected, to say now you actually have more expenses for telephone account. So it actually an expense increases on debit side, so you actually need to debit it, but just take into account that's actually that money going out, and effectively you are decreasing your equity. So I think this one is for a salary, where we say we paid the salary for 6,000, which we actually paid by check. So it's the same principle where you'll say your bank account decreased, and then you actually take that money, and then you need to credit your bank account. And now the account involved in this case is a salaries account. So for expenses, like for all these other accounts, if it's telephone, it will have its own tier account. If it's salaries, it will have its own tier account. So salaries is an expense, so it's gonna decrease the profit for the year. And then also taking into account that effectively is decreasing our equity. So those are the transactions that we're gonna look at. Then just do an example on, and then we'll also just have a look at how they actually do in the general ledger. So with this, the trial balance. So the trial balance actually what it does, you take all the balances for all your accounts in the general ledger, which must also be, the debit must be equal to your credit side. And basically what accounts increase on the debit side, you put them on the debit side, and the accounts which actually increased on the credit side, you put them on the credit side. So these accounts must always be equal, because each and every transaction which you put in the ledger, you're following the double entry system, that what you do on the left, you also do on the right. So what you do on the debit side, also do on the credit side. So a trial balance is basically a list of all balances, like on a general ledger on a particular date. So this is actually when you prepare financial statements, this is the first part where the preparers will actually start, because with the general ledger, it's actually prepared like as and when you pay for telephone, then you actually go and record that transaction, then it automatically posts into the trial balance. So with a trial balance, you have all those items. Basically, if you've got a trial balance, from there on, it has all the elements of a statement of financial position. It has all the statement of other comprehensive income. So you can take a trial balance, and then from there on, you just prepare your balance sheet and your income statement. So the names actually, because these amounts are actually taken from the general ledger, they need to appear as how they actually appeared in the general ledger. So it just shows to say there's actually two columns, which actually, so this is just an example of a trial balance. So it's basically the debit, it just shows you debit, credit, and the main aim is just to say whatever the total amount of debit must equals to your credit amount. So this basically follows the principle to say a bank increases on the debit side, it's an asset. Capital, it increases on the credit side, it's an equity. Tools and equipment is an asset. So it follows that same principle. If it's services rendered, we said it increases on the credit side. These are expenses, and then we actually put them on the debit side. So it follows that same principle where we actually need to come to say, we have all this information now from our general ledger. Now we actually need to come and populate the trial balance, ensuring that the debit is equal to our credit side. So we'll also have what we call a profit or loss account. So with the profit or loss account, we'll also just post some for when we're actually doing what with the general ledger now. It's actually made just to say what profit or loss did the entity make over a specific period. Because we actually looking to say what income in total, because you're going to have your services rendered account, for example, you're going to have your fees account, or with expenses, like in our examples, we had telephone, we had salaries. Those are two different expenses. So we actually need to come and add them together to say total expenses and total income. And from there on, if our expenses are less, and then we'll say, okay, we actually made more income. And in that case, we've got profit, which we need to come and take that profit and actually post it into our profit or loss account, which will effectively go to our equity. So this is how a profit or loss account is. So basically, it's just to close off all those accounts, which we actually said we have telephone expenses, which was on the debit side. So actually going to go to telephone account and actually just credit it and to close it off. So we'll just also just do an example to see how does this. So this is actually the balancing figure to say we had services of 80,000 and these are our expenses. And so this is the balance that we say, okay, actually credit here, putting it capital, but actually sort of saying basically it's your equity account. So this information, this is actually the same information, it's just in different formats. So you actually start to say trial balance, to say this is trial balance. But remember, trial balance, it has both items of statement of financial position. So from here, you say your bank, your capital, your tools and equipment, build big dust, these loans, these debtors. So up to here from 20,000 upwards, these are elements of statement of financial position. But your services rendered, your telephone expenses, and your salaries, these are elements of statement of profit and loss and other comprehensive income. So your balance sheet, trial balance will have all the information. But when we come to say now we're looking at profit and loss account, for example, we're only gonna see only items which relate to financial performance, which are the bottom three, which we have here is the 80,000, the 1.2, and the 6,000. This 72.8 is actually a balancing figure. So this is when we'll say, we have a look to see, actually what you're gonna do is say, okay, here I've got 80,000, and then you say 1.2 plus 6,000 is actually 7.2. You compare which one is actually bigger. And you say, okay, here it's bigger, so it means I need to balance here. So this is the balancing amount. And then you actually close your account, just taking into account that because we're actually dealing with the financial performance items, the closing account is actually closing to equity for a specific year. We don't actually carry it over to the next year. So hence, that's the difference to say last week, what we're doing, we're saying balance brought forward to say if you had debt, for example, if you owe someone 5,000 as of 31 December, you can't come and say it's a new year on the 1st of Jan, I no longer owe you that 5,000. You still owe that 5,000. So you actually just need to take that into account. So this same information which you see on the profit or loss account, if you have a look, is basically the same information again. So this is just presented differently, where you actually say to say, this is your services rendered, and these are your, normally what companies will do is actually just group these expenses to say distribution, admin, or other expenses. Other companies, they just say these are operational expenses. Then they list it down to say telephone or salaries, or other. Sometimes what you can do, because the preparation of financial statements actually gives you that option to say, you can just say distribution, admin, and other expenses, and you put 7.2, and you put the note here to say note number 5. And under note number 5, that's when you'll say, oh, my distribution admin expenses actually is telephone and salaries. So it's either you can put it here, but for big companies, because it's going to be a lot of them, what they actually do instead is just to put one item, then they go to the notes to say, if you need more information about the distribution expenses, you can actually go to note number 5. So this is the same to say 80,000 minus 7.2, you get profit for the month. So this is actually the profit which is actually gets posted to your equity account. So it's actually the same principle. It's just that's how it's actually done differently. So these were the transactions which we're looking at. So what I actually did was just to create to say, this is the accounts, relevant accounts. And as I said, we're going to look again at the profit and loss account, and then to see how do we actually post the account. So, but with the profit and loss account, you'll see when we get the take into account, we only look at the items related to the income statement. So debtors, it's a statement of financial position account. So we won't actually take it here. Same as bank, which is an asset. So assets and equities and liabilities, they are not part of the profit and loss account. So, but we'll see when we go there. And then after that, what I want us to do is, even though we won't have the full information, so our trial balance will actually sort of, in this case, we don't have your equity and stuff, So we'll just do an extract to say how do these transactions which we have done now actually come and post into the trial balance. And I think from there on, after we're done, we're just gonna look to say how do we take this in. So basically this information, we start here. This is our starting point. And after we have this information, we'll say, okay, we have now our TB, our trial balance. So TB, I mean trial balance. We have our trial balance. And then after our trial balance, because this week we're looking at the financial performance side. So last week we actually, if you remember, so I just actually put this in the same sheet. So these are the transactions we looked at last week. So this is only just items related to statement of financial position. And this is how the statement of financial position looked. So now this week, we're going to look at the items for statement of financial performance. And we're going to look again with the TB. So last week we didn't look at the TB. We just took the information straight to the statement of financial performance. And here we're going to look to see this is our. So basically you'll hear other people will either call it to say statement of profit and loss and other comprehensive income, because with a, or sometimes you'll hear statement of comprehensive income. So that's what mostly most people look at. So it also depends again on the presentation. It's open. So most of the time, like with this one, you'll see you have elements which relate to profit and loss. You put it at the top, and you'll see other comprehensive income. You put it at the bottom, if any. Or you basically just say statement of other comprehensive income, which actually means the same thing to say is basically your what was previously referred to as your income statement. So let's just start with one transaction. So we'll just do the ledger for all of them. After we've done, then we'll just go and post all of them together to the relevant TB as well as the statement of comprehensive income. So the first transaction, so it's basically just copied and pasted the ones we looked at now at the presentation, just to make it easier. So we have company A, which we said is actually render the service, but this time is actually for cash, and then to a client for an amount of 60,000. So same principle. So the first principle, which you actually, when you have a transaction, you actually need to look at is which accounts are involved. Just take note that in some cases, not often, you might find actually have 3 accounts, but most of the cases it's actually 2 accounts. But either way, you need to know that what you do on the left, you also do on the right. So if you put 60,000 on the debit side, you need to put 60,000 on the credit side. Even if you say in this case, you've got 3 accounts, if you put 60,000 on the debit side, you need to put the total of the credit accounts, if it's 60 or plus 20, but it needs to make sure that for each and every transactions, your T account basically needs to balance. So in this case, we've got to say company A, so actually dealing with a general ledger. So here it will be the name of the company. And here with a general ledger, remember you need to put either you put, sometimes you just put date to say which is the date, or you split to say year or month. And then here you put details. So details is important because it's actually is the account which you are actually, in this case, if you did put the debit here, it means it's the account you're actually crediting. So here you put the name of the account, and the amount is actually the other important thing. So you actually need to put the date so that at least the marker needs to know. If, for example, you come and put 16 January here, but you're actually recording the first transaction, you'll actually put 16 January and you put 60,000. According to the marker, the transaction which happened on the 16th of Jan, it was for an amount of 20,000 if it affects your bank account, not really that amount. So the dates are actually important, the details is important as well as the amount. So those things that you need to say, for example, if you say, okay, or in this case, let's just say we say 2001 January, we need to say, okay, on which date does this transaction happen? So in this case, we're saying it's a cash transaction. We say, okay, we render the service. So if we render a service, what happens to our, which accounts are involved? Same principle applies. We said it's our bank account because we rendered for cash. So in this case, we say, because we rendered a service, did we get money in or did we pay money out? But in this case, the company A rendered the service, so we received the money. A bank account increases on which side? It actually increases on your debit side. That's the thing to say. Bank account just, again, is the thing which actually confuses people. You need to oppose it with your personal bank account, taking into account the statement you get from your bank account is from a bank. So the bank actually owes you money the moment you put money with a bank. So to them, you're actually a creditor. So hence they need to give you a statement showing a credit balance. But that's the thing, that's the confusion where people to say, but why do I get my statement from a bank with a credit while I put money in my bank account? And when I deposit money, it increases on the credit side. But that statement is from a bank. So the bank actually owes you. If you owe someone, you actually put a credit to say it's a liability, it's a creditor. So it increases on the credit side. So in this case, dealing with a company, just remember that, don't confuse, especially with bank accounts. So the rest of the accounts are simple, but bank account is normally what confuses people, especially when you try to say, I want to actually relate to how does this affect my personal life. So a bank is an asset which you have, and then it actually increases on the debit side. So on this case, we need to put the date for the transactions which we need to record. We said it increases on the debit side, but which account is it actually increasing by? So remember details, you need to put the name of the account because it actually gives you an indication to say what you put here is what account you actually go and put on the opposite side. So you can't put debit on the bank account. Say, for example, in this case, we say services, we render the service. So we actually gonna come and say services rendered. And then we say for the amount, in this case, we're saying 60,000. So the main thing, first thing, the moment you've got one transaction, just need to know that the other transaction need to be credited. You can't come and say services render 60,000 and put services render 60,000 here, because then your accounting equation doesn't balance. Because then you will have assets of 60,000. Remember, accounting equation is assets is equals to equity plus liabilities. So when we come and you say, okay, now you've got, so you're going to have 60,000, which is an asset which will on the debit side. And if you say you're debiting your services rendered, that will be a minus 60,000. So 60 plus 60,000 and minus 60,000 are not equal. It's either you have negative, negative or positive, positive. So this just, you basically, you put the account which you're going to credit. So the moment you've got one leg, so you say, okay, basically this is the account I'm crediting. You open a T account for that account and you say, okay, services are rendered. So this is the account basically you're crediting. So already because you debited it here, so the date is basically the same date which you put in there. So you'll put 2001-01 and you put the same date. Details, same principle apply. Which account are you debiting? You debited the bank, and then you put the thing, and then the amount needs to be the same. So 60,000. So we're done with the first transaction. So second transaction, we need to follow the same principles. First thing is we check which accounts are involved. In this case, it's still services rendered. So we're still going to use the same services rendered tier account. So we don't open another services rendered tier account. It's the same. So we have already a services rendered account. And then, but this account, they said now they've rendered it on credit. So remember, if somebody actually owes you money, in this case, they actually called a debtor. So you have a debtors account in this case, where you actually come to say, okay, you need to remember a debtor is an asset. So it actually increases on the debit side. So you'll need to come to your debtors account. So you can either start with your services rendered or your debtors account, is up to you. So you'll put the date And then you say this time it was on the 16th of Jan. Remember, there's marks allocated for dates as well, so as well as the details. So you just need to make sure that you actually just populate that. So details is services rendered. So the amount in this case, we said we rendered our services for 20,000. So because we already debited our debtors account, we said we're going to credit our services rendered account. So we go to our services rendered account. We put on details, we put the account we debited, which is debtors. So basically it's just to oppose these transactions. You put the date so that the marker will know, okay, I'm actually reporting this transaction. So sometimes with when they mark these things, normally like with this transaction, you might find to say it has 2 marks, but maybe there's a one mark for amount, half a mark for details, and half a mark for date. So hence you actually need to put it to say, even if maybe, for example, you miss the amount or you miss something, you still get half marks along the way. So services rendered, we said it was for 20,000. And then so we're done with our account. So the main element is each and every transaction before you close it, total for debits must be equal total for credits. Transaction 3, we said it's a business telephone account, which we paid by check. Remember, check, it means we paid by using our bank account. And so in this case, we need to say, okay, which 2 accounts are involved? In this case, we said it's our bank because we paid by cash, and also a telephone account. So telephone account is an expense account. So for us to actually record this transaction, expenses increase which side on the debit side, and bank, we said it's an asset. So if we take money and pay from the bank account, we're actually decreasing our bank account. So our bank account decreases on which side? On the credit side. So we need to come to say, okay, this is the year and the month. So date, we said it happened on the 28th. What? So we're actually crediting our bank account here. We're actually crediting it with what? So which account was involved? We can say telephone account or telephone expenses, as long as we've got telephone in there, so that we can say telephone and what amount is involved, 1.2. So same principles. Remember, we said we're gonna debit our telephone expenses. So we need to come and say, okay, same date. We need to put in there. We said it happened on the 28th. Which account did we credit in this case? Remember what we're putting on the debit side. It says which account did we credit? It was our bank. What was the amount? 1.2. Let me just confirm. Yeah, 1.2. So this transaction, we actually credited 1.2 and we debited 1.2. So our accounting equation for transaction 3 balances. And then we can move on to the next one. So on the 31st of Jan, that's where we actually said we paid the salary for Jan for 6,000. So it's the same principle to say which 2 accounts are involved. So we paid the salary, but we paid the salary how? We paid the salary using a check. So the amount is actually 60,000, 6,000 I mean. So we actually need to come to say, if it's bank, what is happening to our bank? Is it increasing? Is it decreasing? We say, okay, no, we took money out of our bank. It's actually decreasing. So which side does the bank account decrease? So that T account, that's the thing you need to always remember to say. If it's a bank, you know, bank is an asset, it decreases on the credit side. Because we're trying to decrease it, we need to actually record this transaction on the credit side. So we put the date, and then we say what account are we actually using to credit this account? This is actually for salaries. And then what was the amount? We said we actually paid 6,000. So because we credited bank account, this is the account which actually we are debiting. So we actually need to come and open a T account for salaries. And then with this T account, we say put the date. Then on what day did this happen? Which account? Because we said that which account did we credit? We actually credited our bank account, and the amount is 6,000. So that records all our transactions which happened for the month. So with this account, so what happens now is, remember, we have items, accounts which actually relate to the statement of financial position, which are our bank and our debtors. And we've got the other items, services rendered, telephone expenses, which relate to our statement of comprehensive income. So these accounts, when we actually close them, we actually close them differently. So I'm just gonna show you now. So these ones will actually just be a repeat of what we did last week. So with our bank account, same thing, we'll just need to say which side is actually sort of bigger. So here we've got 7.2, here we've got 60,000. So actually this one, we actually need to say the following month, we actually need to say balance carried brought forward. So there's need to be a balance which we need to carry forward here. So this will be at the last day of the month. I'm just going to show you so that at least we see when we do the TB. So, but remember, this is just a snapshot, so our TB won't really, it won't be really complete because we don't have some of the items. I just wanted to show you how these transactions actually populate in there. So it's going to be balance carried forward because this is a balance sheet item. So with that, what you actually do is you actually need to say, this is, you actually need to sum all the amounts in the debit side. And in this case, you need to say, here I've got 60,000, but this 60,000, if I minus this and I also minus this, what is the balance? So this is the amount you actually need to carry forward. So so here you'll come and you say the beginning of the next month, you've got balance brought forward. So this is this amount to say beginning of Feb. So this will be next month, the 1st. So you say beginning of Feb, I actually have in my bank account a balance of 52. So let's just do the same for data. So for same principle applies for statement of financial position item. So you do this for your assets as well as your liabilities. And for expenses, that's where you actually sort of close them off, where you actually saying, now I actually need to close and post it to my profit and loss, basically posting it to your equity account. So with the debtors account, you'll say, okay, what's the total here? The total is the same. We don't have any other transactions. And then you'll come and say at the end, what is your balance carried forward? And then you say, okay, it's basically this 20 because there's actually nothing. And then you total debt. So after you carried forward, you need to make sure that these totals are the same. But what then you also need to do is to say, now I need to take this amount. So this is actually this amount. So it should be this here. You need to come and say, okay, this amount which I carried forward from the previous month is actually going to be the amount which I'm actually using to open the following month. So this actually what happens to your statement of financial position. So I think there's a question on the bank account. No, I think I subtracted the both of them. For the carried forward is 60,000 minus 1.2 minus the salaries. So it's basically 60 minus the 7.2, which actually will come, and then the difference is 52.8. Not sure if that answers your question, but I think you let me know if maybe I need to elaborate further. So that's a statement of financial position item. So this is basically what we did last month. So I think there's also a recording if you need more details on how to close off statement of financial position items. So, but now we've got new items to say services rendered and telephone expenses as well as salaries. So how we actually close this account? So the difference is because these are financial performance items and we said they are for a specific period. If maybe we say we are doing transactions for January, we need to close January. But with a bank account, we just don't go and say January is ended. Now we need to go and take all our money. We still just continue. So with services rendered, because these are financial performance items, we actually close them using the profit and loss account. So this is the account which we actually come and use to say, now we are closing it. So here will come basically all of them. I'll just put one, but it will be the same date. And then we'll see. So details, remember the details is the account you're actually planning to credit. So you say profit and loss. So here I'm just putting it here because already there's nothing on services rendered on the debit side. So already I know I need to actually close it using this. So here we actually need to say to add these two to say my services rendered had a credit balance of 80,000. And here to close off this amount, if maybe there was 200 in here, I was going to minus it, but there's actually nothing. So 80,000 minus 0. And then we put 80,000. And then after this profit and loss, you can just add to make sure, especially if there's different amounts, to ensure that there's nothing. So now we actually have profit and loss. Remember what this account actually reflects the account you're planning to credit. So you actually said, okay, I debited services rendered. Which account am I crediting? Profit and loss. So you come to your profit and loss account. You put the name of the account here. And you say services rendered. And that's the amount. So it's 80,000. So just that's doing same thing. What you do on the left, you do on the right. But the aim here is actually we are closing these accounts. So basically next month, come end of next month, we won't have an opening balance on services renders. We don't have opening balances on income and expenses account. We close them off. When they say books are closed, they basically mean they are closing all our expenses. Hence we'll say for this month we made sales of 500. That's it. So it's either we close books for the month or we close books for the year. So if we closed books for the month, we actually can't unless we have to do and say we're actually reopening it. Or if it's books for the year, what we can do is when we prepare books for next year, we can say, you know what, last year there was an element we missed, and then that's when we'll hear on the Fs, they will maybe put at the top. Because remember, Fs are prepared in comparison. Current year, last year, when they say restated, so they mean there's some items for last year which they actually felt they needed to go and reopen. So actually close the services rendered account. Same principle for telephone expenses. We need to say which account actually is bigger. So if maybe there was a reversal somewhere of 200, we're going to be left with 1,000. We must just need to make sure that we add which side is bigger and just take into account whichever side it is. But because expenses increase on the debit side, most of the time you expect the amount to be this side. On the credit side, it's just that part where you say, for example, for salary, it says, no, we paid this person 6,000. It was an overpayment. It was supposed to be 5,000. Then we reverse 1,000. It's only those other odd cases. So telephone expenses, in this case, we follow the same principles. We add to say, okay, here we've got 1.2. And then we come to say, okay, now we're actually looking to say, okay, which account must we use to actually close our telephone account? We will say with our profit and loss. So our profit and loss account, but it's only 1.2. So we just closed off the 1.2. And then you can just, to complete your equation, just add it together. Remember here we're saying which account, if we're putting it here, we're saying which account are we debiting? We're actually debiting our profit and loss account. So here we come profit and loss account. We said which one are we debiting. We'll have a look here at the top. So it's our telephone. So telephone expenses. Which amount did we say we close our telephone expenses with? We said it was 1.2. So that's what we actually need to close. So we actually closed our telephone expenses. We closed our services rendered for the financial performance items. We only left with salaries. Same principle applies. Just this. So we say, okay, here's only 6,000. And then actually what account do we actually need to say to close it with? We close it with profit and loss. What actually is the amount? We only have 6,000 in here. And then just to add for completeness. And we said, okay, this is salaries. We credited profit and loss here. Basically it's saying which account are we debiting. Just whatever you do on the left, you do on the right. So we did this transaction on the right. We actually need to come and do it on the left. This will actually guide you which account you go to. Here we said profit and loss. So if we come to profit and loss, we check again to say we're actually taking it from which account, from salaries. So as long as you get the two accounts correct and you know which one first to credit, then the other you can just do it. So now we've got profit and loss, we've got our accounts, so all of them are closed. What's left is we need to close our profit and loss. So I think the main thing with accounting is basically you make these accounts, basically you need to balance in a way. So here we actually say we need to determine whether we made a profit or loss. So that's what actually this account does to you, is to say, did we make a profit or a loss? So for services rendered, we rendered services of 80,000 during the month. Then we paid the expenses of 1.2 and we also paid the expenses of 6,000 during the month. So in this case, we'll say, okay, here we can either say put equity. Sometimes you'll hear some they put capital. So it depends to say basically it's the same thing. But once you look at maybe Fs for big entities, they call it to say this is actually goes to retained earnings. So it's anything. So all of them, because the retained earnings is part of equity. So, or some you say, okay, it actually belongs to the owners in a way. So here we know we've got 80,000. So this we know is already bigger. And here that's when we'll say, okay, the equity amount which we are putting basically is the difference to say 80,000. Then we deduct all the expenses. So if we've got 5 or 10, we're actually just gonna deduct all of them. And then we say we actually left with 72.8 in our capital account. And with that, we'll actually just add this to say this needs to actually equals to this. So we're done with our profit and loss account. We're actually done with our general ledger. We've managed to close them off. So with our TB, with this our trial balance, we actually basically just take all these amounts and post it here. So these amounts, the closing balance. So with a TB, you actually just the part to say, have a look at it. So if this is like your bank, so remember our bank, we take the balance. So the balance which was remaining, it was 60 minus these two, actually left with 52.8, which was basically, so we'll say your bank. So bank, remember, it's like the debit side. So basically it's this amount. And then we'll come and check which account do we have. So with a TB, normally what it does, it groups them together to say items for financial position at the top. And when you go to the bottom part, then they put items for statement of financial performance. So in this case, we're going to say, let me just group it again. We say debtors, your debtors, how much was your debtors? This is the 20,000. So you have your account, and then again, we'll come and says, okay, now we're looking at your financial performance side. We'll say services rendered. Remember your services rendered here is like it's on the credit side. So you say, okay, how much actually was your net services rendered? So it was actually this 80,000. You can just take it here. And then same thing, you say, okay, now you've got your telephone. So telephone expenses, you actually say, okay, how much is your telephone? This is the 1.2. And then you've got your salaries. So basically you take all those amounts there. Your salaries, actually it was your 6,000. And remember in this case, but basically we did is we actually had this equity account. So we can just say equity just to indicate. So just to take note that actually we just are doing this sort of high level. So this actually say there's going to be an account here to say of 72.2. So if maybe we had our opening balance in this case, that's what I'm saying. This is just an extract. Let me just say extract so that at least you see it's just some items from the balance sheet. So this is actually where your amounts will be. So if we had started from the beginning, so it's just that we just did 4 transactions. So that will then will actually just make sure that, okay, we've got your, so this is just the balance. So this actually was actually get posted in there. So I think this actually just, if you remove this, then these two will actually balance. So we'll just actually just show it here now. So these are all your transactions, but that's just an extract. So same information here if you actually prepare a statement of other comprehensive income. So basically what you do here, you actually just need to say, you actually just taking these bottom elements. Remember, this will actually be part of your statement of financial position. So this will actually be part of your financial performance. So in this case, it's actually the same thing. It's just that you actually just need to say revenue. So what to follow that format is to say what is your revenue, and then you can actually say here what does your revenue comprises of, where you say services rendered. So if you have a note, you can put a note, and then you actually just look at your TB. You said your revenue was actually 80,000. And then here you can say, okay, your expenses here maybe you can say admin or operational expenses. And then that's where you say, okay, now you need to come and list your expenses. We had only 2 expenses, which was your telephone, and then you also have your salaries. So how much did we say your telephone? So in this case, you can just say, for example, you can put your expenses like here because they're negative. You can just also just put negative amount so that at least you can see when you're actually adding it together. Your salaries, our salaries we said was 6,000. Or in other cases, you see people, they actually add everything together and put the negative here so that at least you can see just not to cause. Or what other people do is you can put them as positive, but you say it's a revenue, but here you indicate, you say less operational expenses. The person knows that to say this is actually net off. So this is actually just the sum of this two. Let me just bold this. So this will be your revenue. Then you've got your operational expenses. And then this is basically your profit or loss. So after having your revenue less expenses, so where you'll say, okay, I take all my revenue, then I minus my expenses. Okay. Now I need to edit because I have a positive sign. I have a negative sign. So this is basically 72.8. So I think that's actually how all these transactions which we did actually leads to say this is the 72.8, which said basically we're gonna post to the equity account. So next week we'll actually be focusing on the cash position. So if maybe you can just have a look at that, and then you can just try to practice just to see how it looks like, so that at least when we do this together, then you can see actually, and then also ask questions if maybe there's an example you attempted and you also just didn't understand what was the principle, or what were they trying, or how did they do something differently. So I think there's a difference between question on the difference between sales and cost of sales. So sales is basically your revenue actually which you make. So if you are selling an item, so mostly you'll see cost of sales in manufacturing companies. So with an example, like say for a bakery, they will sell bread. So the amount which they get from selling bread, that's their revenue, that's their sales basically. Cost of sales, because it's manufacturing bread and it uses flour, it uses yeast, and in that case, they also have to say they also need to put maybe basically materials and labor. So in that case, that amount which they used to buy the flour, the amount they used to buy the yeast, the amount they used to hire that specific baker, they call it cost of sales. So it's the cost basically to say this cost is actually just related to making the sales. So hence you have your sales and your cost of sales, and then you've got your gross profit. So gross profit is saying we actually made bread of 7 rand from the sale of bread. We spent 5 rand, but it's not actually their profit, because they need to pay maybe the rent where they actually doing the bakers. They need to maybe pay for electricity, all those other stuff. So cost of sales is basically the direct cost, which is mainly just related to say before this product can be out of the factory, we need this cost. We need to incur this cost. We need to buy flour, we need to buy yeast. These ones is actually just directly related to the bread. Then that's we say for a company, you'll see sales, then you'll see cost of sales, then you'll see gross profit. To say if there was nothing else, but for your hence the salary of a baker will normally be on cost of sales. But for a salary, maybe for example, of a distributor or someone who's in the office, that will be your other operating expenses, because we also need someone to actually take that bread to the shops, but you also just need that to make the business. But for the salary, you say this is your labor for the person who actually need to actually mix the flour and stuff. So I'm not sure whether I answered your question. And then in that case, I'll just write my email, or if maybe there's questions, or if maybe you need to set up one-on-one sessions, or if there's things you do not understand to say you can need to assistant of, you can just send me an email and then we can take it from there. Yeah, so I think that's it from me, unless there's anyone who has got more questions. And then I think we'll see each other next week on Thursday. Just remember, guys, I think you'll get most out of this if you actually at least have a look at to see what, like for now, we're going to be discussing cash. Like what does the no say? What does it look like? Do you understand it? So that it's also, when we talk about it, to say, is it repetition? Okay, this I understand what they were saying, or you actually explaining it this way, but I thought the study guide was maybe explaining it this way, and then we actually need to see how it was actually working. Okay. Okay, thank you. I think that's it for me.